A Chinese billionaire just placed a $300 million bet that silver is about to collapse. His name is Bian Shiming. He made nearly $3 billion betting on gold. He doesn't gamble, he doesn't guess, and right now he's shorting 450 tons of silver on the Shanghai Futures Exchange. That's 30,000 contracts, the largest net short position in the exchange's history. While silver dropped 16% in recent weeks, his paper gains have been stacking. But here's what they're not telling you. While Bian Shiming builds his short fortress, the Trump administration just convened 54 countries in a closed-door meeting about critical mineral supply chains. J.D. Vance and Marco Rubio didn't host a trade summit. They declared economic war. And when you hear the phrase critical minerals, understand what that actually means. It's code. It's always been code. They're talking about silver, physical silver, the kind you hold in your hand, the kind that powers every solar panel, every electric vehicle, every missile guidance system, every smartphone, every weapon system in modern warfare, the kind China has been quietly accumulating while the West slept. President Trump is not going to allow China to corner the silver market. And what you're watching right now is not a market correction. It's a knife fight between two superpowers over the most strategic metal on Earth. This isn't the first time this has happened. It's happened 3 times before in recorded history. Same pattern, same sequence, same outcome. Every single time, an empire reaches the point where it can no longer afford its own currency. Every single time, the smart money sees it first. And every single time, physical assets become the only lifeboat while paper burns. This is not theory. This is not speculation. This is historical pattern recognition. And once you see the pattern, you can't unsee it. Rome didn't fall because of barbarians at the gates. Rome fell because it destroyed its own currency from within. The silver denarius, once nearly pure silver, the backbone of Roman commerce and military power, was systematically debased over centuries. By the time of Emperor Claudius in the 1st century, the denarius was 94% silver. By the reign of Trajan, it dropped to 85%. Under Marcus Aurelius, 75%. By the 3rd century crisis, under Emperor Gallienus, the denarius contained less than 5% actual silver. It was a worthless token wrapped in a thin silver wash. Soldiers were paid in coins that bought almost nothing. Inflation exploded across the empire. A measure of wheat that cost half a denarius in the 2nd century cost thousands of denarii by the late 3rd century. The population lost faith. Trade collapsed. The legions couldn't be paid. The borders couldn't be defended. The empire fragmented into warring pieces. It wasn't conquered from outside. It rotted from inside. The currency died first. Then everything else followed. Verified. The Dutch Empire controlled global trade in the 1600s. Amsterdam was the financial center of the world. The Dutch East India Company was the most powerful corporation in history. Dutch ships dominated every ocean. Dutch banks financed kings and wars. Then they fought endless wars. The Anglo-Dutch Wars, the wars against Spain, the wars against France. Military spending exploded. Debt piled higher and higher. The currency started to weaken. Confidence began to crack. Physical gold and silver started flowing out of Amsterdam and into London. By the early 1700s, financial dominance had shifted to England. The Dutch guilder lost its status. Dutch power evaporated. Within 1 generation, the empire that ruled the world became a regional power. The currency collapsed first. Then the empire followed. Check. The British Empire, the largest empire in human history. At its peak, it controlled nearly a quarter of the Earth's land surface and a quarter of the global population. The sun never set on British territory. The pound sterling was the world's reserve currency. London was the undisputed financial capital. Then came 2 world wars. The First World War drained British wealth. The Second World War bankrupted the empire entirely. Britain went into World War II as a creditor nation and came out as a debtor. The debt was crushing and unpayable. In 1944, at Bretton Woods, the United States took reserve currency status from Britain. The dollar replaced the pound. Within 3 decades, the pound sterling was a shadow of its former self. The British Empire dissolved. India gained independence in 1947. By the 1960s, almost every British colony was gone. The empire that ruled for centuries vanished in a generation. The reserve currency status was lost first. Then the empire crumbled. Pattern recognition, not opinion. History doesn't repeat, but it rhymes with perfect precision. Now apply that exact same pattern to today. The United States national debt just crossed $36 trillion. That's trillion with a T. $36,000 billion. The interest payments alone are now over $1 trillion per year. More than the defense budget. More than Medicare. More than anything except Social Security. The government is borrowing money just to pay the interest on the money it already borrowed. That is not an economy. That is a Ponzi scheme in its terminal stage. The deficit for this year alone is projected at nearly $2 trillion. Spending is accelerating. Tax revenue is not keeping pace. And the only solution they have left is to print more currency. But here's the problem. The rest of the world is watching. They're watching very carefully, and they're making moves. China just reduced its U.S. Treasury holdings to the lowest level in 18 years, $682.6 billion. That's down over $600 billion from the peak in 2013. Where did that money go? It didn't vanish. It moved. It moved into gold. China's official gold reserves just hit an all-time high, 74.1 million ounces. They have doubled their gold reserves while cutting their dollar exposure in half. That is not random portfolio rebalancing. That is not passive investment strategy. That is preparation. That is a country preparing for a world where the dollar is no longer the reserve currency. Treasury Secretary Bessent recently acknowledged in careful diplomatic language that he has heard reports about China developing a digital currency backed by physical commodities, not backed by the renminbi, not backed by Chinese government bonds, backed by gold, backed by silver, backed by real things, for use in international payments, for use as reserve assets. This is not conspiracy theory. This came from the Treasury Secretary's own mouth. You can't unsee it once you know what you're looking at. Meanwhile, back to that 54-country meeting that almost nobody is talking about. J.D. Vance stood in front of representatives from nations that collectively control roughly 2/3 of global GDP. 2/3? That's not a small gathering. That's not a courtesy meeting. That's the formation of a new power bloc. And J.D. Vance said something that should have been front-page news everywhere, but was buried. He said that despite all the focus on digital economies and technology and artificial intelligence, real physical commodities remain fundamental to everything. He said the nations in that room represented the power to create true independence and self-reliance in critical minerals. Then, he said something even more important, something that should have sent shockwaves through commodity markets. He said that international critical minerals markets are currently failing to create sustainable domestic industries or secure supply chains. He pointed directly at concentrated supply chains, meaning China, and persistently suppressed commodity prices influenced by forces outside individual nations' control. That's diplomatic language for price manipulation. He acknowledged that mining projects constantly stall and fail because of erratic and unpredictable pricing that makes long-term investment impossible. Nobody wants to spend $500 million building a mine when the price of the commodity can be crashed 20% in a week through paper derivative games. Then J.D. Vance said the explicit goal of this coalition is to stabilize pricing to enable domestic supply chain development. Read between those lines very carefully. The United States government, at the vice presidential level, just officially acknowledged that critical minerals markets, including silver, are being artificially suppressed. They admitted it, out loud. At the highest levels of government, they admitted the pricing mechanisms are broken and dysfunctional. They admitted that intervention and restructuring are required. That is not a policy discussion. That is not a think tank white paper. That is a declaration that the manipulation is ending and a new system is being built. This was not a meeting to talk about the problem. This was a meeting to coordinate the solution. 54 countries. 2/3 of global GDP, all agreeing to restructure critical minerals markets away from Chinese control. While that meeting was happening, something else was happening in the physical world that you need to understand. Australian bullion dealer City Gold, a well-established dealer with years of operation, halted all silver sales. Not because of a temporary surge in demand, not because of a logistics delay, because of a global silver shortage. Those were their exact words. Global silver shortage. Actual physical metal shortage. They literally cannot source the product. Retail sales paused indefinitely until supply becomes available again. Think about what that means. A major bullion dealer in Australia, a country that mines silver, cannot get physical silver to sell to customers. In India, the multi-commodity exchange just hiked silver margins by 7% and gold margins by 3%. Now, exchanges don't raise margin requirements because everything is running smoothly. Margins get raised for one reason only: fear. Fear of default. Fear that volatility is about to explode. Fear that too many traders are positioned on the wrong side and the exchange itself could face a clearing crisis. Notice that gold margins went up 3%, but silver margins went up 7%. If gold were the real source of stress, gold margins would have been hit harder. They weren't. Silver was hit more than twice as hard. That tells you exactly what the exchange fears. High margins equal stress in the system. Stress equals positioning risk. Positioning risk means too many people are on the wrong side of the trade, and the exchange is scrambling to protect itself from a default event that could bring down the whole clearinghouse. They are not protecting small investors. They are not promoting market fairness. They are protecting the system itself from catastrophic failure. The market is screaming at you what it fears, and it's not gold, it's silver. Now look at what's happening on the COMEX, the primary futures exchange for precious metals in the United States. Another 608 silver delivery notices were issued on Wednesday alone. J.P. Morgan, the largest bullion bank in the world, issued 531 notices and stopped, meaning took delivery of 239 contracts. Total COMEX February silver deliveries have now risen to 3,563 contracts. That represents 17.8 million ounces of physical silver. And we are only 4 days into February, which is not even a primary delivery month. Primary delivery months are March, May, July, September, and December. February is supposed to be quiet. This level of delivery activity in a non-primary month is extremely unusual. It signals that someone, or many people, want physical metal right now, and they're willing to stand for delivery on futures contracts to get it. In the gold market, 2,692 delivery notices were issued on Wednesday. Barclays issued 1,304. JP Morgan stopped 740. Citigroup stopped 1,000. Total February gold notices have risen to 32,004 contracts, representing 3.2 million ounces. Physical demand is absolutely relentless. Month after month, the physical offtake continues at levels that strain the system. But here's where the situation becomes truly bizarre and reveals the tension in the market. Silver is currently trading in backwardation, nearly 80 cents per ounce in backwardation after one of the most brutal price slams in recent history. Let me explain what that means because this is critical. Spot silver, the price for immediate physical delivery, is currently trading approximately 80 cents higher than the March futures contract, which is the front month contract. In a normal functioning commodity market, futures prices are higher than spot prices. That's called contango. It reflects the cost of storage, insurance, and financing over time. You should pay more for silver delivered in 3 months than silver delivered today because someone has to store it and insure it during those 3 months. But when spot is higher than futures, that's backwardation, and it only happens for one reason: desperate shortage of physical metal available right now. Backwardation means market participants are willing to pay a premium to get the metal immediately rather than wait. They're paying 80 cents more per ounce to get it today instead of March. Why? Because they're not confident they'll be able to get it in March, or they need it immediately for industrial use and can't afford to wait, or they believe the paper price is about to explode higher and they want to lock in physical now. Backwardation of this magnitude, especially after a sharp price decline, is a massive red flag that the physical market is far tighter than the paper price suggests. The paper market says silver is abundant and price is falling. The physical market is screaming that silver is scarce and you better get it now while you can. Those two signals cannot both be true. One of them is lying. History says the physical market doesn't lie. Paper markets do. Now zoom out and look at the broader macro picture, because what's happening across all markets right now is truly historic. Everything is crashing simultaneously. The crypto market hit a record high market capitalization of $4.3 trillion on October 6th of last year. Today, the total crypto market cap is just $2.3 trillion. $2 trillion of market capitalization has been completely wiped out in 4 months. That's 46% of crypto's entire value evaporated in a matter of months. Bitcoin, the flagship cryptocurrency, just dropped below its 2021 all-time high. All the gains from the past cycle have been erased. U.S. stock markets are falling on weak economic data. The Nasdaq dropped 1.34% in a single session, wiping out $517 billion in market cap. The S&P dropped 1.13%, erasing $695 billion. The Russell 2000 Small Cap Index dropped 1.5%, losing $47 billion in one day. The labor market data that triggered this sell-off is genuinely terrible. Initial jobless claims rose to 231,000 versus expectations of 212,000. That's a significant miss. Layoffs are accelerating across multiple sectors. January job cuts were the highest since 2009, the heart of the financial crisis. Companies are announcing almost no new hiring plans. When layoffs rise and hiring slows at the exact same time, that is a classic leading indicator of recession. It means companies see trouble ahead and are battening down the hatches. The market is starting to price in that reality right now. Here's what should genuinely terrify you. The US dollar is collapsing at the fastest pace since 1980, the tail end of the worst inflation crisis in modern American history. Today, the dollar is the second worst performing currency in the entire G10. Just 1 year ago, it was the strongest. That reversal is staggering. In just 3 months, nearly every major currency has surged against the dollar. The Australian dollar is up 8%, the Swedish krona is up over 10%, the New Zealand dollar is up more than 5%. In currency markets that normally move by fractions of a percent, these are seismic shifts. Why is this happening? Political uncertainty in the United States is exploding. Trade policy has become aggressive, unpredictable, and inconsistent. Tariffs are imposed on allies and adversaries alike with little warning or clarity. Markets are now pricing in the risk of a broader global trade war. The result is what traders are calling a sell America trade. Global institutions are cutting exposure across the board, selling US stocks, US bonds, and the dollar itself. When capital flows out, currencies weaken. It's simple supply and demand. At the same time, confidence in Federal Reserve independence is eroding. Public political pressure to cut rates regardless of inflation data raises doubts about whether monetary policy is still credible. Add in the exploding fiscal deficit, debt rising with no realistic plan to stop it, and the long-term value of the dollar comes into question. On top of that, the weaponization of the dollar has pushed even allies to quietly reduce exposure and shift toward alternatives: gold, silver, and hard assets. This isn't theory. These capital flows are measurable. Now, zoom out. Everything is crashing at once. Stocks, crypto, bonds, commodities, currencies. Even real estate is softening. That does not happen in a healthy market. Diversification only fails under extreme systemic stress: forced liquidation, mass deleveraging, or a collapsing manipulation structure. Precious metals sit at the center of this battle. Paper markets scream abundance. Physical markets scream shortage. One of these signals is lying. And here's the key detail. The brutal smash in silver and gold derivatives happened immediately before the 54-nation critical minerals ministerial. That was not coincidence. It was strategy. If prices were surging into that meeting, it would validate claims of market dysfunction. Crashing prices create doubt and confusion. It was a final show of force by the paper system. But the response was bigger. The meeting went forward. Policy moved anyway. Because physical reality always wins. You can manipulate paper prices for years, but you cannot print silver. What we're witnessing now is a coordinated global reset of critical minerals. The Trump administration deployed 3 weapons at once: price floors to support higher, stable prices, massive expansion of domestic and allied production, and cutting off Chinese access to Western metal. This is not a proposal. This is economic warfare, and the old system is losing control. While BN Scheiming builds a $300 million short position, betting that paper silver prices will fall, the Trump administration is doing the opposite. It's restructuring the physical market to make sure prices rise and stay elevated. So who wins? A single Chinese billionaire with a massive paper short, or 54 countries representing 2/3 of global GDP coordinating policy to reshape the market? Long term, this isn't even a contest. But in the short term, the billionaire might still be right. Here's why. When sentiment becomes excessively bullish and positioning gets crowded, corrections happen, even in structurally tight markets. Human psychology never changes. Greed flips to fear. Leverage gets unwound. Weak hands are forced out. We've seen this repeatedly since the 2022 bull market began. Every correction felt terminal. Every time, it wasn't. Prices pulled back violently, then resumed the uptrend and made new highs. That same tension is playing out again. The fundamentals are real. Physical shortages are real. Dealer halts are real. Backwardation is real. Industrial demand is growing. Policy support for domestic production is real. But short-term positioning became dangerous. Too many speculators, too much leverage, too much complacency. BN Scheiming's short, India's margin hikes, and forced liquidations across markets all point to the same thing: overcrowding. Technicals are deeply oversold, similar to past major bottoms. But oversold doesn't mean prices can't fall further. During deleveraging events, markets can stay irrational longer than traders can stay solvent. Still, the divergence is impossible to ignore. Paper markets say abundance. Physical markets say scarcity. One of them is lying. At the same time, the United States and China are now openly competing for control of critical minerals. This is no longer background noise. It's the main event. The 54-nation ministerial was a declaration. J.D. Vance's statements about ending manipulation were a line in the sand. Price floors, domestic production incentives, and export controls are the enforcement tools. This is a direct counter to decades of Chinese accumulation. So here are the takeaways. First, BN Scheiming is not a gambler. He made billions on gold and is betting silver falls further in the short term. Second, physical stress is accelerating even as paper prices collapse. Dealer sales halts, massive COMEX deliveries, and persistent backwardation all confirm it. Third, the timing of the derivatives smash ahead of the ministerial meeting was strategic, not accidental. The unresolved question is timing. Does deleveraging push prices lower first, or does the physical shortage collide with policy intervention and trigger a violent squeeze? We're already off the cliff. The only uncertainty is how long it takes before everyone looks down. This isn't a crash, it's a wealth transfer. And history is brutally clear about who wins when paper burns and physical disappears.